Maxim ETM Investor Confidence Index for the second quarter declined by 7% to 99.1, suggesting marginal bullishness for equity markets. Russell Lamberti, strategist at ETM, now joins me at the desk to delve further into the details of that report. Thanks so much, Russell, for joining us today. So we've got that index, as I said, dropping to just above the 99-point mark from 107 points in Q1, and that an easing back for the second quarter. And some would say, hardly surprising that we've got this coming through where there's such a degree of uncertainty plaguing the markets at this stage on a global scale.
Yeah, I think that's a broadly correct assessment. It's not particularly surprising. We felt that when we released the Investor Confidence Index in quarter one that we were likely to see a downturn, and we've certainly seen that coming through. So in some ways, the Investor Confidence Index confirms what we believe to be true in the environment, but definitely coming through. And if we unpack some of these subcomponents of the index, certainly some interesting stories to be told as we look down.
Let's drill into it, because there's been a lack of growth in overall fund inflows for the second quarter of 2011, and that certainly goes hand in hand with what some of the traders at the desk have been saying over the recent past, that they've just been sitting tight because they're just not sure where to go at this stage.
Yeah, so new fund inflows seem to be slowing down significantly. Anecdotal reports from the fund management industry in general is that it's a very tight space at the moment, that if funds are getting new inflows, it's generally that they're taking them from somewhere else in the market rather than a broad degree of new fund inflows. And then I think if we look at asset allocation and how fund managers have allocated between equities, bonds and cash, what we've really seen in the second quarter is basically no change from the first quarter. So very much a sitting on our hands kind of feel coming through in the numbers, which to me just suggests that there's a lot of uncertainty about that. Investors are not really, they don't have a strong conviction on their calls at the moment, and there's a lot of hedging going on and a lot of short-term strategies happening, and rather than sort of these kind of long-term big moves into equities or bonds or anything like that, we're just not seeing that.
Oh, when you say there's no change from the first quarter, let's take a closer look at asset allocation and largely speaking how things are being allocated at this stage and the trend in terms of asset allocation.
Yeah, so the ASISA data that we draw on is simply showing that the overall pool of funds is fairly stagnant at the moment, and B, that the difference, the allocation between stocks, bonds and cash is quite static. If anything, we've seen a slight rotation back into cash, but we've also seen a slight rotation back into equities. So that's almost counterintuitive. And bonds have sort of treaded water. So again, I think it definitely gives this overall sense of uncertainty. What has served to really drag the Investor Confidence Index lower in the second quarter are the other factors that feed into the index, which are the VIX, which is the index of volatility and risk aversion, if you like, the risk aversion index, if you like. That certainly ticked higher in the second quarter. My biggest surprise actually is that it didn't rise further, given that we've seen what we've been through in Europe, what we've been through with the US situation. And I think that's probably testament to the fact that central banks have provided so much liquidity onto the market that cash squeeze that usually causes that VIX index to shoot up just isn't happening at the moment. But that's certainly one to watch, and I think that is definitely weighing on the index.
Something that certainly caught my attention is the fact that we've seen a slowing of momentum of new domestic funds into bonds during the quarter, and that stands in contrast to what we've seen from the foreign side of things, where it's foreign inflows that have been supporting our bond market or flowing into that bond market for over the recent past. So let's hone in on that kind of distinction that needs to be made in terms of what foreigners are doing in our market relative to what the domestic investors do.
That's a great point, and I think very simply to sort of distill it to its essence, foreigners have been deterred from investing in bond markets overseas. Clearly your sort of tier one treasuries, gilts, German bonds, those markets have held up fairly well, of course. But obviously the general risk aversion overseas has been significant, and the default trade has not always just been to go back to the US or go back to the UK. It's often been to go and find good yield in healthy, strong fiscal situation economies in the emerging market space. And so clearly, South Africa's benefited from that. Locals, by contrast, I think have become worried about inflation, which foreigners have been less worried about from a South African perspective. Locals are worried about inflation. Inflation has ticked up. That of course erodes the value of your bonds, and so I think locals have certainly been less gung ho than foreigners have. My feeling is looking forward that's going to start to shift around again. Not necessarily that foreigners are going to sell out, but that locals are going to start joining the party again. We are not of the view that inflation is going to be a sustained problem, and if we see inflation just starting to come down again and growth risks reassert themselves, then I think bonds become quite attractive again. So I wouldn't be surprised to see the bond market from a local perspective doing a bit better.
Also, there had been this expectation that the SARB would raise the repo rate by the third quarter of this year, and that certainly kept investors interested in money market instruments. But there seems to be a fast shift happening in that arena, where that interest rate outlook and that tightening cycle is now being projected to only begin in 2012. What's your outlook in that regard?
Yeah, we would, we've been saying for a long time that a rate hike in 2011 is just very unrealistic. I think if a hike is going to happen in 2012, it's probably going to be later in the year. And I agree. I think that has, to a large extent, informed the investment decisions that we see coming through in this number. And I think there's a big change in mindset happening. People are starting to realize rates are going to stay low for a very long time in this economy.